We've talked about so many sectors, but Sunil Singhania, I would love to have your views on, one of the topics that we have been hearing about of late, which is private sector banks versus public sector banks, just the way the valuations have also moved. Now, in this time of volatility, when we don't know when the US Fed will increase rates, by how much, it will impact the banking landscape back home as well. How would you play this theme?
So financials, we are quite optimistic, and it is both fund-based financials and non-fund-based financials. See, this public sector versus private sector and all, obviously one has to keep in mind. There are obviously advantages which a private company would have over a government-owned company. And therefore their valuations to their extent also are better. The other thing which we have to basically take into account is not only the absolute price to book or the PE, but also the growth and the return on equity which goes behind it. And I think wherever you find, even on the public sector side, that this matrices are working out better, you have seen investor interest being pretty high. So for 2021, for example, a lot of private sector banks, the so-called very, very good private sector banks, have hardly given you any returns. There have been a couple of so-called corporate private banks which have given you great return. And then you have a host of public sector banks which have given you fabulous returns. Because, from complete, ignorance and complete apathy towards them, these banks obviously perform much better than expected. And we have come to a semblance as far as their valuations are concerned. So as I said, as an investor, you have to keep your eyes and ears open and keep on looking at stuff. But I think it is logical to say that private sector would trade at a slight premium or a decent premium to public sector undertakings because of the freedom they enjoy. From our side, we do have small exposure to a couple of public sector banks, but our exposure to the financial services is predominantly in a couple of the so-called corporate banks, a few NBFCs, and a lot of non-fund-based financials, which would include insurance companies, some broking companies also.
So Pankaj, now mid and small cap stocks have corrected. Every major mid-cap sector has seen a 15 to 25% drawdown. If the starting point is 22nd of February 2022, are we in for now decent returns, given that a correction has already kicked in?
I think it's still some time away before the stocks becomes extremely attractive. And the basic premise which we have been talking about is that in the near term, we believe that the earnings upgrade cycle has peaked out. And we have been saying this for last couple of months. And third quarter, we saw the glimpse. Fourth quarter, our sense is by listening to the commentaries by the management, by doing our channel checks, that the demand momentum is still very weak. And margin pressure is sustaining across different companies. And as a result, my sense is fourth quarter, as we move into that, still 45 days to go, my sense is that there could be earnings downgrade in the fourth quarter number as well. So once the street adjusts itself to the new reality on margins and top line growth, I think that will be the time to reassess the stocks at a new valuation point. And I think till that time, volatility will continue. We may have different distractions like Russia, Ukraine, China, Taiwan, or maybe US Fed at that point of time. And this volatility will give us, enough opportunity to buy good quality franchises at our prices and valuation. So we still believe there's still some time away before we go and buy the market full-fledged.
Gautam, it's definitely some recovery inside, but I don't know how sustainable it is because there are just so many moving parts, especially with, the news flow around Ukraine and Russia. But having said that, we've made it back to 17,100. What's the chart indication like? Do you think it's going to stay? Is the worst behind us? Or would you say it's pretty much a work in progress, each day as it passes?
Well, I guess at some point of time, this correction of the last 5 months had to happen because I think we were all used to seeing the markets witness a shallow correction and come back. And that's something which happened every single time since the Nifty started to rally from the March 2020 lows. But I think in October, November last year, since the time we topped out at 18,600, the news flow has not held. And let's not forget, the US markets are the big daddy. When they are volatile, when they are weak, India and the rest of the world, just gets into a bit of a shell. And that's exactly what has happened in the last 3 months. Any which way, I think the market was a little top heavy, and that's probably the reason you're seeing this correction. But to be honest, the headline indices do not depict the kind of damage that has actually happened beneath the surface. If you really look at the NSE 500 or the entire NSE basket, on an average, the drawdown is about 30-32%, which is very large by historical standards. So I just feel that for the short term, the fall is pretty much done with. 16,850 was and remains a very important support level. That's the number from where the Nifty has reversed yesterday as well. And today we are seeing a rally led by good breadth, as you rightly highlighted. So I do believe that there could be some stability over the next 3 to 4 trading sessions. The news flow around the Russia-Ukraine conflict is now pretty much discounted. You can't hit the market every day with the same news flow. So I would want to believe that the Nifty gets into a range, 16,850 on the downside, 17,500 on the upside. And if you actually look at the breadth readings, we are at historically oversold levels. So these are levels from where investors should definitely look at buying opportunities. I know for traders, it's a nightmarish market currently because you are seeing major gap ups and gap downs. But for investors, with a 12-month, 18-month, 24-month horizon, this is a very good time for risk-reward based buying in many of the sectors.